Federal Reserve has just issued a warning about an incoming recession right around the corner as a result of some of President Trump's economic policies in what some are now calling the Trump session. Here is the chart from the Atlanta Fed that shows the estimate of what GDP is going to be doing very soon here. And if you look at the blue line, they expect it to fall off the cliff into negative territory. When the GDP number is positive, that indicates economic growth. When that GDP number tips negative, it indicates that the economy is shrinking. And when that happens for 2 quarters in a row, that's called a recession. That is, unless, of course, it happens underneath President Biden. You can see on this chart as well the orange bars, which show the actual change in US GDP. And you can see that the Atlanta Fed's estimates are pretty close and usually fairly accurate. Now, there are quite a few reasons to be concerned about the economy. Consumer sentiment in January slumped to the lowest level in 3.5 years. Retail sales dropped by the most in about 2 years. Real spending has been falling at the fastest pace since 2021. And as you can see from this chart, cities' economic data surprise is negative, and it is also the lowest since September. Not to mention the fact that most spending in our economy in the US right now comes from the richest 10%. This also happens to be the same percentage of people who own the most US stocks. And as this stock market has been extremely volatile lately, that spending has been slowing down. But it is not just consumer behavior that people are looking at as a sign of an incoming recession. Many people's attention is turned squarely towards the White House to see what Trump's economic policies are going to do to the economy. And they're primarily looking at 2 things that this administration is doing. Number 1 is spending cuts. Number 2 is tariffs. There is one camp that tries to make the case that if the government spends less, that is on net going to be worse overall, both short-term and long-term, for everybody else. In other words, everyone in the private sector is on the receiving end only of the government's magic money tree. And if the government just arbitrarily decides to stop spending money for no reason at all, then everybody else will suffer as a result. Now, I hope the fact that you are around this channel and you are watching this video means you know that that viewpoint is complete hogwash. You don't have time to dive in to MMT and Keynesian economic policy today, but if you're interested in a video on that topic, let me know in the comments. But even if we disregard that viewpoint, there are many who say, hey, look, it would be better and healthier for our economy long-term if the government restricts its spending. But they say that will result in short-term pain. And here I would like to challenge even that. The fact is that every single dollar the government spends first has to be taken from somebody else, because the government does not produce any income. They do not create any value. They do not sell anything. They have no revenue generation. The only way that they can spend money is first taking it from somewhere else. They do that primarily through 3 different sources of taking that money. Number 1 is going to be direct taxation. You look at your paycheck, see, hey, I made $10,000 this period. Oh, but look what hit my bank account. It was only $5,000. And that's because the other 5 of it went to pay for various taxes. The second way the government takes money is through borrowing. Now, this is voluntary, but it is still a transfer of purchasing power from one person or entity to the government. And then the third way that the government spends money is by printing it into existence. Now, sometimes this is done in conjunction with borrowing, but overall you get the picture. There's 3 ways the government can take purchasing power, and they're all taking it away from somewhere else, either through taxation, borrowing, or inflation. And the truth of the matter is that that dollar that they spent, if it is left in the hands of whoever they took it away from, it would be used more productively if it is left in their hands. Consider this from your perspective. You look at your $10,000 paycheck and you get $5,000 at the end of the day from that. How much better off would you be if you got $6,000 of that 10? 7, 8, or maybe even, crazy idea, what if you kept all the money that you actually earned? Would you be better off? Would you save more? Would you spend more? Would you invest more? The answer to that is certainly yes. You would be much better off. You would also be making the lives of the people around you much better off. For instance, the people who own the businesses that you buy stuff from would be instantly better off because you would be buying more from them. You would also be taking some of that money and you would be investing it. In other words, you would be putting that money back into the economy in order to allocate that capital to productive enterprise to grow the economy and grow that business, and you would receive some of the profits as a result. That's what investing is. And guess what? If you save some of that money as well, you financially become more robust. You don't have to rely on debt as much, which means that if hard times come, you can keep spending and investing. You don't have to withdraw and contribute to the economic pain around you. You can actually alleviate it if hard times come around you. So you can see from an individual perspective, it is blatantly clear if you are able to keep more of the money that you earn and produce, you will be better off and you will make the lives of everybody else around you much better off as well. Now, let me ask you a question. Is there a lag effect with this? In other words, does it take a year or 2 years for any of those positive results? No, you get your paycheck and it is more because you get to keep more of what you earned. It instantly makes your life better. You instantly save more. You instantly invest more. You instantly spend more. There's no lag effect with this. And so if the government reduces spending overall, now you might say, wait, hold on though. If the government spends less money, that doesn't mean they're taking less money out of my paycheck. And at the beginning, you're absolutely right because they're running a deficit right now. So they take all the money from you in taxes, but then they still spend more than that and they have to borrow. So at the beginning, if they spend less, they're just going to be borrowing less. But remember, they are still taking that money from somebody, from somewhere when they borrow that money to spend. And if those financial institutions and those savers and those businesses are no longer lending that money to the US government because the US government's not borrowing it anymore, it's going to have to be lent out somewhere else. And if it's not going to the government, it's going somewhere else in the private sector, in the economy. In other words, it's going into the hands of people who are productive with it, individuals and businesses who produce wealth and produce goods and services. In other words, who make money. And so no matter which way you slice it, the more the government cuts spending, the less money they spend, the more capital is left available immediately in the private sector, in the real economy, and it's left in the hands of individuals who will be producing more wealth with it. So despite people's fears that government cutting spending will result in short-term pain, long-term gain, that is not how this works. When the government leaves more money in the hands of private individuals and businesses, they immediately benefit. So next, all eyes are on tariffs. Everybody is wondering what the economic impacts of tariffs are going to be. Some people are saying they're going to be inflationary. Some people are saying deflationary. Some people are saying it could wipe hundreds of billions of dollars off our GDP. I'm going to show you exactly what you should expect from tariffs in just a moment. But first, I have an urgent announcement about a free event that I have coming up for you. You don't need me to tell you that 2025 is so far shaping up to be an incredibly volatile and chaotic year. With the stock market already seeing a 10% correction in the NASDAQ, wild swings both up and down, geopolitical chaos abroad, and pretty much every day we are seeing news of things going one way or another. But the key is that all of this volatility and all of these surprises and changes represent opportunities. And so that's why on March 27th, write this date down, 7 p.m. Eastern time, I'm hosting a completely free asymmetric trading masterclass on Zoom. This is going to be a live call and I'm going to show you how you can use asymmetric trades to profit from things like massive geopolitical events, the ongoing trade war, market crashes, currency crashes, extreme volatility, and more. All throughout modern history, asymmetric trades have handed out some of the biggest returns in the market to the people who knew how to use them, especially during market times like we have today. And I've personally been using this strategy to grow my portfolio over the last 2 years. If you're interested in learning exactly how it works and what asymmetric trades I'm looking at right now, click the link in the description below to sign up. Like I said, attendance is completely free, but the spots are limited. Last time I hosted one of these masterclasses, we had more people register for the event than could actually fit on the Zoom call. So if you're interested, make sure you sign up now to secure your spot, mark it on your calendar, and I'll see you there. So are tariffs inflationary, deflationary, or are they going to result in wiping out a massive chunk of our GDP? Well, I want you to think about this from the individual perspective again. A tariff is simply a tax, and that always gets passed through to the cost of the product. In other words, the consumer is the one who ends up paying that. Now imagine that something that you buy every single month suddenly becomes 50% more expensive because of an artificial tax imposed on it. Whether that's gas or your car insurance or your mortgage or food. If any of those items were to receive a 25 or a 50% tax imposed on them, the cost would immediately increase by 25 or 50%. Now, for any of those items, you are going to look at that and you're going to say, okay, well, I have to keep buying it, but I didn't get a raise. My income didn't increase in order to compensate me for the higher price of gas, for the higher cost of home insurance. And so if my gas costs me $200 more this month, that means that I have to spend $200 less somewhere else. And it's not like I'm saving that money. That money is still being taken away from me. I'm still spending it. So I still have the same net outflow, but now I have fewer goods and services that I'm getting in return for the exact same amount of money. And this is exactly where people get confused about tariffs, because when a tariff is placed on an item or on a country, those things get more expensive. So if you are measuring the price of those things, there will be inflation. The price of those things will go up. But if everything else is equal, in other words, let's say in a perfectly flat, neutral world where nothing else adjusts, there's no government money printing or anything like that, you wouldn't have overall net inflation because every individual, in order to buy that item, if they choose to keep on buying that item, means they have less money to spend anywhere else. So if you're measuring the overall price level, like they tend to do when they're measuring inflation with something like the CPI, you're not going to see overall inflation as a result of the tariffs. One thing is going to get more expensive and the other things are just going to have less demand. So all else being equal, those prices would drop. So by themselves, all else being equal, tariffs are not inflationary overall. And that's because they reduce demand for everything else because there's less money available for everything else. Now here, a lot of people say there would be short-term pain, but long-term gain, because eventually all of those things that we are buying from somewhere else, we will instead buy from here. That takes time. There is an argument to be made that is accurate, that there is a lag time there because you can't just build factories overnight and start pumping out goods from inside the United States versus buying them from overseas. There are plenty of car manufacturers and businesses who are right now talking about moving production to the United States as a result of uncertainty around tariffs, but they don't have any expectation that they're going to have production starting in the next couple of months. They're looking 1, 2, 3, 4 years down the road from now. And let's say all of that does go through. You are still artificially imposing a higher cost of doing something somewhere else instead of where it can be done for cheaper and for better. Imagine the example of an attorney who can type at 100 words per minute, who decides to hire a typist who can type at 20 words per minute. Because of comparative advantage, it makes sense for the lawyer to hire somebody even though they are worse at typing than him. Because while he gives up $20 per hour to hire the person to type for him, he can turn around and bill an extra couple of hours per day that he would have spent typing. He can use those hours and bill them at $500 an hour. The same exact thing happens globally. There is no reason why we should artificially be restricting free trade and stopping people from buying things from somebody else who is able to make that thing for cheaper. And by the way, just for everybody who in your mind you're thinking, well, what about all of the countries like China that are cheating because of the financial manipulation and money printing and their subsidies, and they have a top-down controlled communist economy and they're cheating and taking advantage, and so they're taking all of our manufacturing. You are maybe unknowingly saying that central planning and communist top-down control of economies works better than free markets. And you're saying in order to compete with the communist top-down control economies, we have to be more communist and top-down and controlled and have a government tell us who we can and can't do business with? You're saying you don't believe free markets work. And that's fine if you believe that. That's a discussion for another time. You're wrong, but it's okay if you think that. Just make sure you're aware that's what you're saying when you're saying we need tariffs to compete with China. So in the end, yes, tariffs, all else being equal, are a big drag on the economy. They make things artificially more expensive, and even if that causes us to do that production ourselves, it's still not as good for us as being able to buy it from them for the real cost, just like it wouldn't be as good for the attorney to type for himself. Now, I've made a point to make sure I was saying all else being equal when we were talking about things like tariffs and government spending cuts, because nothing happens in a vacuum. And in fact, if you look at this chart, you can see that from about September through December of 2024, global money supply was shrinking pretty rapidly. There is a lag effect from the changes in the money supply and how it impacts economies, because it takes time for new money or the lack of it to work its way throughout an economy. And so because of that, it makes sense to me that we've seen so much volatility in the stock market and why we see so much pessimism recently in regards to the economy. But that trend has reversed. Since the beginning of 2025, the growth rate of the money supply has reaccelerated and the money supply has started to grow again. And it's not slowing down anytime soon. Especially in Europe, we are starting to see a rapid acceleration of money printing and easing. This is very bullish for asset prices and for the economy, at least nominally. It's also important to note that markets are not equal to the economy. Just because there is a recession doesn't mean that there will be a bear market, and just because there's a bear market doesn't mean there will be a recession. In fact, like I pointed out earlier, the NASDAQ is already down 10% from its all-time high, and the average stock in the S&P 500 is also down 30% from its high. If you remember, bear market is just at least 20%. So most stocks have already corrected and entered bear market territory before the recession has ever even started. At the end of the day, nobody has a crystal ball, even the Federal Reserve. And there very well could be a recession around the corner, but remember that it's a debt cycle, not a business cycle, and recessions are the results of the artificial booms caused by government intervention. They are not an excuse for more of it. Less government always and forever will mean more healthy economy and ultimately more money in your pocket. Please remember to sign up before it's too late for my asymmetric trading masterclass. Remember, it's completely free, it's live. Click on the link in the description below. As always, thank you so much for watching. Have a great day.